Learning Objective 12-4 is to translate financial statements of a foreign subsidiary, and a few preliminary steps before we get into the example here. For revenues and expenses, when we translate, first of all, remember when we translate when the subsidiary uses its functional currency, the parent uses its functional currency, and they're different. So you would need to translate from the subsidiary's functional currency into the parent's functional currency. And for revenues and expenses, you're generally going to use the average exchange rate for whatever the period is. If there's a single material transaction, then that would be translated using the rate in effect on that date. Assets and liabilities all go at the current exchange rate, and stockholders' equity goes at historic rates, with one exception, that's retained earnings. With retained earnings, we're going to need to roll it forward. We're going to need to take the beginning retained earnings at whatever was carried forward from last year's calculation. We're going to convert over net income at the average rate, dividends at the historical rate, i.e. the date of the dividends, and retained earnings at the end will again be kind of a mixed combination. We'll talk about that. And what's going to happen is if you use all of these different rates, including the conversion that we talked about for retained earnings, then when you do the trial balance for the subsidiary and you convert the trial balance of the subsidiary at all these various rates, it's probably not going to balance. The probability of it balancing is almost zero, and therefore you're going to have a difference. And that difference will be called the translation adjustment. If it's a credit, it's a gain. If it's a debit, it's a loss. And this is going to go to other comprehensive income. So it says here it's part of the entity's comprehensive income. That's because it's part of net income. So it'd be one of the adjusting items of other comprehensive income. And remember that the three basic adjusting items are changes in foreign currency translation adjustments. That's what we're talking about today. Unrealized gains and losses on available for sale securities, and deferred gains and losses from certain derivative instruments. And remember that other comprehensive income, accumulated other, is kind of a shoebox, and these are all sort of temporary items where you put gains or losses until you can realize them on the income statement. So in a way, all of these foreign currency translation adjustments, every year you do this calculation, you come up with a gain or loss. It's going to go to OCI, and then it's going to go to accumulated other comprehensive income items on the balance sheet, and it's going to sit there in the shoebox. And the reason why is because this could have a big impact on income, and we don't want it to have a big impact on income because nothing has really happened. You have a foreign subsidiary. The value of the foreign subsidiary is going to go up and down with the value of the currency of the country where the subsidiary is, and that's going to have a major impact on the company. And management really has no control over that. And therefore, we place it in the shoebox in other comprehensive income. And let's just go over the mechanics again in case you don't remember. In net income items go to retained earnings. Other comprehensive income items they get closed to accumulated other comprehensive income. And this is a separate item in this balance sheet under stockholders' equity. And on your statement of change in stockholders' equity, you show the accumulated balance of other OCI items, plus or minus these various changes, like this is one of them. Remember what the other ones are. Equals the accumulated balance of OCI items at the end of the period. And this will be reported on the balance sheet as part of the stockholders' equity section. So let's go to the translation template now. And in this example, Peerless purchased 100% of German for $63,000. And there's an excess here. I'll just tell you about it. I think I worked out the difference. No, I didn't. Yeah, I did the difference. But there's an excess above book value of $3,000. And this is attributable to a patent for 5 years, which has a 5-year life. And the local currency for German company is the euro. The functional currency for the German company is euro. And on October 1st, the subsidiary declared and paid dividends, $62.50, of which we would receive 100%. And the subsidiary had a sales transaction with a U.S. company, basically sold something to a U.S. company in U.S. dollars of $4,200. So this is even though the subsidiary is in Germany and uses euros, they made a sale denominated in dollars of $4,200. At the time, the direct exchange rate was $1.20 per euro, and the subsidiary still has these dollars on its balance sheet. So here you can see the two companies' balance sheets, Peerless, you know them, right? And German, right here. And the relevant direct exchange rates are January 1st, 2021, a euro is worth $1.20. October 1st, 2021, $1.36. That's the date of that dividend. And December 31st, 2021, $1.40. And the average for 2021 was $1.30. So here's how you would do your translation. You have cash for $1.20. All your assets, this is a translation, so all your assets will convert at the current rate on the date. So this is the date of acquisition here. All your assets will convert at the current rate, as will accumulated depreciation, that's a contra asset. Bonds payable will also convert at the current rate. Now this is the date of acquisition, January 1st. So common stock was just acquired. The historic rate's also $1.20, and retained earnings is also going to convert at the historic rate. And so this is quite simple. Everything converts at the historic rate on the date of acquisition. And to multiply this across, 2,500 times $1.20 is 3,000. 5,000 euro times $1.20 exchange rate is 6,000. And then multiply everything across like so. And this is actually quite simple, but this is just on the date of acquisition. We're trying to figure out here what we bought. And you can see here that this is what's on their books. It has, now that we know the dollar value, we can compare it to how much they paid, which was $63,000. So if we work up this little chart, we know the acquisition cost was $63,000, and the book value is in US dollars, the common stock plus retained earnings, or $60,000. And the problem says that there's a patent worth $3,000. And I'm just stating it in dollars, but the reality is the patent really belongs to German company, and therefore it should be denominated in euros because that's their functional currency. I'll talk about that again. So the fair market value of the net identifiable assets, the whole company plus the patent, is $63,000. And goodwill will be $0. So if we were to consolidate on the date of acquisition, then here's the information about German that I just calculated. I'm going to debit common stock of the sub, debit retained earnings of the sub. This is just the date of acquisition, folks. Don't get all excited yet. I'm going to credit the investment value, and I'm going to debit this patent of $3,000. And hopefully this balances. 63 minus 3 is a $60,000 credit on the right. So 63, you say here 63 plus 63, that's good. And then to add it across would be for assets plus minus all the way down. And for liabilities and stockholders' equity would be plus minus plus. Also $1,118,000. Now it gets more complicated when we do a regular year. Again, all assets and liabilities are going to go at the current rate, which at the end of the year is December 31st, 2021, $1.40. So all assets will go at $1.40. All the liabilities, well, here's another asset, accumulated depreciation, and accounts payable, bonds payable will also go at $1.40. Revenues and expenses, on the other hand, go at the average rate. So sales would go at $1.30. So too would go cost of goods sold and operating expenses. And the foreign currency translation loss, it's just a normal expense as far as we're concerned, goes at the regular rate. And then we got a couple things we got to work out here. The dividends are going to go at the historic rate. That would be the rate on the date of the dividend, which was October 1st, or $1.36. We have to do that in order for the dividend to eliminate when we do the consolidation. Common stock is going to go at the historic rate, which was $1.20. And this is where I always give you a little spiel on retained earnings. This is an unclosed balance sheet. By unclosed, it means that it still lists out revenues and expenses. After you close the balance sheet, you eliminate by closing all the revenues, expenses, and dividends. And then all that's left in a closed balance sheet will be assets, liabilities, and stockholders' equity. When you do that closing, just to review, your revenues will be credited to retained earnings, and your expenses and dividends will be debited to retained earnings. So, retained earnings in a closed balance sheet would be as of the year end. Since I haven't yet closed my revenues, expenses, and dividends in this balance sheet, it's unclosed, then retained earnings is still the beginning of the year balance. And therefore, I'm going to convert it at the beginning of the year conversion rate, or $1.20. And then I multiply everything across. So 10,750 times $1.40 is 15,050. 3,000 times $1.40 is 4,200, all the way down. Accumulated depreciation, 7,500 times $1.40, 3,000 times $1.40, all the way down. So that total debits would equal 168,200, and total credits equals 157,200, and it doesn't balance, as we said it wouldn't. So in order to make it balance, you would need an additional credit. Sometimes it's a debit. You would need an additional credit of $11,000. And that's going to be a gain. And it's a translation adjustment that goes to accumulated other comprehensive income. Now let's go through some additional calculations that are important here. The first is, what did German company do when it made this sale? It made a sale of $4,200. at the time when the exchange rate was $1.20. So when it made this sale, we don't know the date of the sale exactly, it would debit cash foreign currency units, right here, because their books are being kept in euros, and that would be $4,200 divided by the direct exchange rate of $1.20, or $3,500, and then record sales revenue. Then the value of these units would go down. So specifically, the exchange rate went down from $1.20 the exchange rate went up to $1.40, meaning that they incurred a loss. So the amount of the loss would be $4,200 divided by 140 minus 120. I'm telling myself 840 can't be right because here it is. It's $500. That's the amount of the loss. So I make a little chart here on the side. This was a $5,000 transaction rate. I'm sorry, $4,200. And at the time, the exchange rate was $1.20. So the value of euros would be $4,200 divided by 120, or $3,500. And then by December 31st, it's still $4,200, but the conversion rate has declined to $1.40. Meaning that in euros, it's now worth $3,000. So the loss would be, there you go, $500. Because it's declined in value from 3,500 euros to 500. And the journal entry to record that would be foreign currency transaction loss for 500, and credit foreign currency units USD for 500.